What's up, box munchers and habitual leg touchers? Happy Sunday, and welcome to another week on Wall Street, or as I like to call it, the world's most expensive casino, where the dealers all have MBAs. It's the first full week of September. Kids are back in school, and the markets are back in therapy. Last week's jobs report told us one thing: the labor market is running on fumes. Only 22,000 jobs added in August. Unemployment's up to 4.3%. And healthcare is the only sector hiring. That was a weird saying, which is perfect because we're all going to need a doctor if this keeps up. So the big question, what should you watch this week? Let's go ahead and break it down. So the big one, we have CPI on Thursday. Circle this in red Sharpie. The Consumer Price Index for August. Economists expect a 0.3% monthly, 2.9% yearly, and core CPI is also at 3.1%. Translation, inflation is not dead. It's just hiding in your grocery bill. Gas prices up. Services are sticky, and tariffs are still working their way through the system like a bad burrito. For the Fed, this is the nightmare. The labor market is weak, but inflation is strong. It's like getting punched in the face and kicked in the groin at the same time. Then we have the Fed meeting countdown. The Fed meets September 16th to 17th. The odds of a rate cut, 100%. Vegas doesn't even bother taking bets on this anymore. But here's the thing. Bad news is good news used to rule the market. Weak jobs meant Powell would cut. Stocks would rip higher, but now cuts are already baked in. So bad news is just, well, bad news. We covered that in yesterday's video as well. What are traders watching? Do we get a baby cut, 0.25%? Or does Powell channel his inner Paul Volcker and slam the panic button with a 0.5% cut? Either way, Wall Street wants the impossible. Strong growth for earnings, weak growth for cuts, but no recession. Basically, they want to be thin, rich, and still eat cheesecake every night. Now we also have some earnings, the few and the proud. This week, it's light on earnings, kind of like a slim fast diet, but the ones we get are actually mattering. We have Oracle on Tuesday, the company that still sells databases like it's 1997, but hey, they've been riding the AI hype train too, so watch the guidance here. Hopefully Larry Ellison isn't out there trying to buy more kids and quarterbacks for his fourth wife's alma mater. So we'll see what happens with Oracle, but I'll maybe put a report on that later this week. Adobe, we have them Thursday. The only company that makes you pay $700 a year to use the fill text box tool. Their AI rollout will be a big deal for this earnings report. And then we have Kroger, America's largest grocery store chain. If inflation is still slamming shoppers, you'll see it in the margins for sure. An honorable mention, GameStop on Tuesday. Yes, it's still alive. No, you shouldn't buy it unless you enjoy setting your money on fire. In that case, I will leave my Cash App in the bio and you can just send it to me. Anyways, we also have housing and mortgage rates. Mortgages dipped again last week to 6.5%, the lowest since October of 2024. But buyers still ghosting open houses. Applications to buy a home are down 3%. Why? Because even with lower rates, prices are still absurd. A starter home in Boise now costs what a penthouse in Miami used to. Unless the Fed slashes rates into oblivion, housing demand isn't coming back fast. And if they do slash rates, prices could skyrocket again. Either way, Gen Z, you're screwed. If you don't already own a home, then yeah, not even Gen Z, anyone who doesn't own a home right now, you're just basically screwed at this point because you'll keep getting priced out by interest rates. Now, some other dates to watch too. Monday, we have consumer credit, expect plus $10 billion. That's America's favorite growth story, maxing out the Visa. Tuesday, we have NFIB, small business optimism, expect around 100. Translation, still grumpy, still blaming tariffs. Wednesday, we have the producer price index, another inflation check. If input costs stay hot, companies will keep passing them on to you, the lucky consumer. And Friday, University of Michigan sentiment Spoiler alert, Americans are not feeling great about $8 oat milk lattes right now. So, what's the vibe? Well, it's kind of complicated. Stocks dropped last week because the narrative flipped. Bad jobs data no longer equals a green light for stocks. It equals recession risk. Treasury yields fell, which is Wall Street's way of saying, yeah, we think Powell's about to blink. But here's the Goldilocks fantasy investors want. Jobs, not too hot, not too cold. Inflation, not too high, but not too low. And the Fed, just enough cuts to juice growth, but not enough to spark inflation back up. That's like expecting your Tinder date to be funny, hot, rich, and emotionally available. Good luck with that. So here's your weekly outlook, folks. Thursday CPI, that's our main event. That's the belle of the ball here. Fed meeting countdown starts now. The debate is not if they cut, but how much are they going to cut? Earnings from Oracle, Adobe, and Kroger give us a read on AI, software, and, well, most importantly, the consumer. And housing stays stuck in limbo, even with rates dipping right now, because that demand is just not there. The big picture, markets are walking a tightrope between rate cut euphoria and recession fears. One wobble, and Jerome Powell is suddenly the guy trying to catch his balance in front of 330 million people. And remember, when Wall Street says bad news is good news, what they really mean is as long as the Fed keeps the champagne flowing, who cares if the house is on fire? Anyways, that's all we got for you this week. Like, subscribe, comment, share, leave your hottest take in the comments. I'll highlight and talk about some of the funniest ones I see. Other than that, have a great rest of your Sunday, and I'll see you guys on the market Monday morning.